So I have a couple of questions, and I'll start out by asking Hans and then Andrei, is where do you think synthetic banking fintechs have been successful, and what challenges have they faced, and things like the issues you asked about customer acquisition, growth, and profitability, and how does that relate to this question of the rent they have to pay to the traditional banking system?
Well, remember I said at the beginning that if you were someone that had a job and were creditworthy and generally had good income to spend, that was a profitable relationship for your main institution. And I'd say even today, many, because of the improvements that the largest banks have made, it's, to me, a completely acceptable experience. You know, you have remote deposit capture, you have lots of digital services. They've improved their applications a lot for both businesses and for consumers. So it's pretty good. But there's tens of millions of people that are not very well served by that. And that could be a poor person who doesn't have access to those services. It could also be someone who has irregular income and you're an Uber driver and you're 16 other things, and then how do you do all your filing for your quarterly tax payments and stuff? It's a lot. There's no system to do that for you easily. So some things are very difficult, and you're not well served by your existing institution. And then many millennials feel they're not well served. You know, things that they just take for granted, you don't get. And so, and also in emerging markets, there were billions of people that had no access to any type of financial service whatsoever. There's also people that, for example, in London, if you needed to transfer money, you're going to continental Europe a lot, into Sweden and other places, and you're moving money around. There's all these ridiculous fees that you're paying all the time, and it's a big pain in the neck. So so many fintechs have attacked those individual problems and gotten millions of customers. So they're providing a valid service with people that love them. And so they're emotionally attached in some cases. They think it's a great service. The problem is, as I said, is the profitability of that equation and what's next. How can you make that more profitable? How can you extend that to a wider array of services? And how much capital do you need to do that? So that, to me, is the issue. But they've definitely proven, people voted with their feet. They say, I like this. It's a great product. And there's quite a bit of loyalty, actually.
Andrei, stickiness is a big challenge for you. Have you addressed that?
No, I second exactly what Hans has said. I think what we've seen in the U.S. context especially, Europe a little bit different, in the U.S. context is that a number of these institutions, including Aspiration, and others even more so, have amassed millions and millions of customers very, very quickly. You think about how many customers the biggest banks open in a month, and there's a number of fintechs that are opening as many, if not more, as the best known banks. And so there is that rush for something different. Again, I think for reasons that Hans pointed his finger on. What are those use cases that people aren't, that the incumbents have not been touching? How do you serve people who are not having the same kind of regular income that a lot of other customers are? How are you solving for individual problems? How are you speaking to some of these issues around distrust and values that I mentioned before? And again, I think that puts us in this fall of the Roman Empire moment where there's just a lot of these moving pieces. What no one has done yet is put it all together. And to say, okay, we are going to be able to have all of the pieces that come together to rebuild a financial home for somebody and really be able to grow something into a large business going to be able to compete head on with the incumbents. And I think the reason for that is how you attack the problem. Why do we still have these large institutions if they're facing this kind of distrust, and if less than 10% of Americans trust them? Part of that is the fact that they're universal institutions. where they're not built for a specific use case or a specific slice. They're built for everybody. They're also serving large swaths of people. And so there's going to be people who, just as if you're an Uber driver, maybe they're not built for you. If you need a branch, and a lot of people in this country still want a branch, they're going to go to those kinds of institutions. So they have a customer base that's still going to be with them for many, many years to come, at least, if not forever. And they're also infinitely capitalized. And that's important as well, because what a lot of these my fellow fintechs have done is say, how can we create an arbitrage? Robo-advisors came up, and there was a situation where a few years ago, if you wanted your assets managed, you had to pay 1% for some guy behind a desk who was going to meet with you, and you probably didn't want to go see that guy anyways, and he probably didn't want to serve you. And they said, we're going to bring that online, we're going to do it for 0.25%. And they started building up a business, and eventually the incumbents respond. And they say, fine, we'll do it online, and we'll do it for free. Robinhood built a tremendous business with millions and millions of customers because they said, why are you paying for trading your stocks? Why are you paying those kind of brokerage fees? It should be for free. Built up a big business, and just this fall, you saw in quick succession this domino effect of Schwab, TD Ameritrade, and the rest suddenly all moving within like a 10-day period and junked the fees that they had had for 20, 30 years. And so these incumbents are eventually able to respond in terms of price, in terms of offering, in terms of technology. And for a fintech to succeed in the long term, you have to be able to offer something that they can't. Or eventually, you're just a force that creates a better value proposition for the customer, but eventually gets squashed.
Thanks, Andrei. So Raj, should we change the law to make it easier for fintechs to get bank charters? And if you think so, where does the opposition come from, and what do you think the chances of change are?
Well, my view is that the economy prospers when there are fewer barriers to entry. So I think the answer is clearly yes. I'm not sure we need actually to have a change in the law, particularly if we're talking about depository institutions. What we need is a regulatory willingness, not just in speeches, but in actuality, to provide these charters. We could, at the margin, deal with some of the obstacles. For example, it's really not necessary that a parent and up the chain be 100% in permissible financial institutions. Why not 85 or 80%? You're not going to really contravene the purposes of the Bank Holding Company Act to begin with. So there is a lot that can be done. I think most of us despair about anything of worth getting done in Congress, so that's why I would look to the regulatory agencies to fill that void.
So Raj, I mean, one perception is today that is if you don't look like the First National Bank of, West Moline, you have, and you have a fintech model, which is not physically based, may have a different asset strategy that's just, not going to work. Is that how the regulators are looking at it these days?
There's certainly a vestige of that, but you do have new leadership at all of the agencies, and I think you have seen at least some verbalization of a willingness to consider new models. You had the comptroller of the currency, Joseph Otting, come up with his fintech charter, which was attacked in the courts and was basically said to be illegal. You have the chairman of the FDIC, and she has made it clear that the law permits what are called industrial loan companies and a receptivity to a charter. I do think there's a question here whether you could see the dam break, and in really the next 6 months to a year. And it's sort of hard to say, well, just this one and nobody else.
Right.
We should probably talk, because I think this issue of why is the United States so different than every place else is worth talking about, because how many people here have lived outside the United States, have a bank account outside the United States? Yeah, so almost all of you realize most countries have one banking regulator. The United States has 57 or something, right? Every state, as Roger's saying, we have this really complicated system. So I think like Singapore and the UK, for example, are actually much more ambitious and interested in this. And I'd say China, my view is like the Chinese government didn't organize, I would say that Alipay and WeChat Pay are functions of the fact that they had a monopoly, which made it very difficult for small merchants to get a merchant account. And they came up with a solution that really just went around the banking system, and now it's there and it's gigantic and there's not much anyone can do about it. But it wasn't like the government went out and said, we're going to design this really new efficient system. It happened because there's a giant gap that those two companies drove into. But do you think in the US that the way we're structured actually can permit more competition, or it's just like you said that the OCC tries to get innovative and the states sue them?
One of the problems with the 57 or however many regulators there are is that means there are 57 interested parties in turf, and so if one is invading another's turf, that can be an issue. I know it's all to protect the consumers and everything, but still one has to be a little bit skeptical on that issue.
Well, if I can add some additional skepticism, I'd say the interested parties are not just the 57 regulators. And when you think about why it's been so hard for challengers to move into the space, it's not just an argument among regulators. I'm coming at this from somebody who believes strongly in regulation, believes that we probably need, in many cases, more regulation, smarter regulation. But the fact is a lot of the regulatory apparatus has become perverted and has become about protecting not consumers, but incumbents. And I think it's no accident that we've seen in the US the kind of resistance that we've had to these new forces offering innovative models, because those who are threatened are not sitting in Washington or in state capitals. They're sitting down the road from where we are right here.
Yeah, there's clearly parts of the banking industry, particularly the smaller banks, that have put a lot of pressure on the regulatory system to try to maintain the distinction between traditional banking and fintechs. Hans, if there's one major application which has been languishing, moving forward, but languishing for a true fintech bank, and that would be Varo Money. If that makes it over the finish line, does that mean that the investment environment will change for these types of things, or is there a fundamental difference for the way that a VC will look at a bank, even a fintech bank, and a non-regulated, perhaps faster-growing fintech?
So this is a complicated point I'm about to make, but I really think it's very important, so I want everyone to follow me here. If you are a company that takes risk, then you need capital to support that risk, right? So if you are trading, or if you're lending, or if you have liquidity risk, and the way a financial institution defines risk, you say there's credit risk, liquidity risk, operational risk, market risk are the primary categories of risk. So if you're a bank, you're taking risk, and therefore you need capital. And the capital to be a bank is regulated. And we can dig into that, what that means, but let's say it's about 8 to 10% of the assets that you have. If you're taking deposits, 8 to 10%. The mix of your activities may change that a little bit, but that's roughly what it is. So here's the problem. If the business model that you're pursuing, you come to me or other venture capitalists and say, we are going to get a bank charter, or we're going to become an insurance company, or we're going to become a trading company or something. My question is, how much capital do you need to support that business model? And if it's regulated, it's a regulated amount of capital. So therefore, what are the implications of this? If you get bigger and you get more customers, you need more capital. So let's say you want to grow at 30%, which would be great. And let's say you have a 25% ROE, which would make you the highest ROE of any bank in the United States. And you want to grow 30%, you have to dilute yourself 5%. If you want to grow 200%, you have to dilute yourself 175%, right? You need 175% more capital to support your growth. So from an investor standpoint, it's not a very good business model. And also what we're seeing now, and this is WeWork is one example of it, but public market investors say, well, how much risk do you have? I value, they look at that and say, you got a lot of risk at WeWork, a ton of risk. So I'm not going to value that like a software company. Software companies have 80% margins, 110% revenue retention, and essentially very little risk. Certainly no you may have operational risk, but you're not going to lose all your money to a credit loss or something. WeWork could lose a lot of money to credit losses. And so when the insurance company or bank goes public, they're going to say, well, what's your ROE? And what's your bench? How does that compare to other companies? And maybe if you had a 30 or 40% ROE, you could be at 4 times book value or 5 times book value. But you're not 1,000% of book value. And therefore, you're not a software company. So the valuation is not the same. So I would be very skeptical about investing in anything with that type of business model. It could be a good company, but it's not, you're growing, but your growth requires dilution. And what's your solution to that? You could say, well, we'll lever ourselves more. We'll put the risk someplace else, which is what many companies have been doing. Like, we'll be a marketplace. So, Chicago Mercantile Exchange has really great margins and everything because liquidity, there's incredible margin and liquidity. You're not retaining that much risk through your rules. You still have risk, and that trades at 27 PE or something, but it's not infinite. So that's the core problem. And it's a big issue when we look at these companies.
Okay, great.
Todd, could I just offer a quick comment on one regulatory issue which we have not yet addressed? I failed, and it's mine. And that is, and it's a very enveloping one, and it is what I would refer to, and it's really largely a function of Facebook's Libra proposal, anonymity or pseudonymity of the customers of a financial institution. And for some people, that is a real virtue. But as somebody said earlier, because financial institutions have money, it attracts some bad people. And that's how bad people move money. They've got to do it somehow. It's not all in suitcases. So this is going to be a real issue going forward for everybody, for fintech, for banks, for developers of virtual currencies. And it's a societal issue too, as to how much are people prepared to give up information when they move money or open accounts or borrow money.
Absolutely. So Raj, I know you have to leave us early, but before you go, I have one last question for you, and I want everyone to comment on this. Do you think there are risks that we run from a systemic or other standpoint by not allowing fintechs to become banks? Essentially we're developing the fintech lending economy, particularly, as a large portion of small business lending and some other areas. It's got an unstable funding base. Will have potentially pro-cyclical effects in a recession. So are people thinking about that issue at all?
Perhaps, but I think not enough. And I would go back to 2 points that were made earlier, which I thought were right on. Andrei talked about the desirability of regulation. You want your financial system to be well regulated. We learned the lesson in the lead up to 2008 where the mortgage banking system, which was unregulated and, with due respect, many of the thrifts, really managed to infect the entire banking system. Now, not arguing the banking system didn't open itself to that, but it occurred. And the second is a point which Hans just made, and that is, this is the financial system is global, and if we don't do it here, if we don't have a developed financial system here, which takes advantage of all the innovations in technology, it will be surely done elsewhere. And I don't think you ever have a country with a great economy without a great financial system.
Well, thanks, Raj. I know you have to run, so thanks for coming. And So I have one more question before we turn it over to the audience, which is for Hans and Andrei. What do you think about the recent forays of big tech into fintech, as we think of it? Apple, Google, Facebook, Amazon, Microsoft. Do you think what do you think their game or their play is in terms of their relationship both to the traditional financial system and to the fintechs that have already made progress? Where do you think this is going?
I think there are two big important themes. I think they apply to multiple areas too, which is if you have some software company, software stack that's fundamental to a business, it's how you run the business. And that could be something like Amazon, which has, is effectively a sales infrastructure for many, many different types of businesses. But it could also just be any other company that says they have the best, like MindBody has the software which every single yoga studio and exercise studio and everyone uses. So that software stack gets adopted because it's the best. It's 10 times better than somebody else. So now you got all these people using it. And what do you see? You have the SaaS system, and you're seeing all these flows, and you say, well, why can't we just add a service to those flows, and we'll monetize the flow? And that would be a common thing to do these days, is add payments to your flow. And it becomes integrated into that software stack, and it actually adds value to the operator of the business. Because the operator of that business is not very loyal to First Data. They actually don't care about First Data at all, or Fiserv. But they are very loyal to the software because it's how they do everything. It's how they book people, pay their taxes, do all these other functions. So could you add a service to that? Could you add insurance to that? And also, in like Amazon or PayPal or I think many other cases, Google, Square, they're saying, why don't we just add a settlement? We'll offer, we see these flows, we can offer to pay earlier, and we have a pretty good competitive advantage of risk in that equation because we see everything. So we're not making a 5-year credit decision, we're just making a settlement decision. And there's a 99.99% chance we're right because we see all the data. So you have a competitive advantage of information, and you have a competitive advantage of origination. Those are two very important things. So in my view, that is part of the financial services that any tech company, not just the big company, any tech company is interested in monetizing more of these relationships. And we could then go apply that to like an Apple or Facebook or as I said, companies like Square or Amazon. But I actually feel to stick with that theory. I've got something. It's very sticky. I'm seeing stuff flow through. I can use my competitive advantage of origination and information, create a better product from that consumer standpoint.
So the interesting take there is the Chinese situation where, essentially the payment vehicle was created not as a freestanding business, but to facilitate the core business in the case of Ant. And so there was a large other business, and payment was a logical extension to make it work better. And so that's how they got into payments rather than viewing it as an independent business. So.
Yeah, and if you then say, well, would I rather own, how far do you want to go? And I'd say, well, if I'm Amazon and I'm paying Wells Fargo like 1/10 of a basis point to actually be the underlying processor, like, Yeah, I could. Why do I want to do that? Why do I want to get in the middle of all that and have to, So it's like, I don't see the, they're taking as much of the margin from that as they can, but I don't think they have to necessarily become a regulated institution.
We're talking a lot about fintech. The truth is, fin has always been tech, and tech has always been fin. You go back, 150 years ago, what was the largest financial institution in the country? Was Western Union. What did they have? They had the technology. They had the telegraph. They weren't just sending telegraphs back and forth. They were sending money. That's what they were doing. That was how people moved money back then. You go back not even 150 years ago, go back 30, 35 years ago. Before Amazon, there was this thing called Sears.
Right. Really, more or less invented consumer lending in this country.
Well, you walked into any Sears in the country, and there was a Dean Witter. And that's where people would go, and they'd buy their mattress and buy their barbecue grill and buy their mutual fund at the same time. In the 1980s, Apple had a credit card. There was an Apple card that you'd get when you picked up an Apple, and you'd get a credit card as well. So none of this is necessarily new. All of the attributes that Hans talked about are true, but what they have most of all, these institutions, is yes, data, yes, origination. They have customers. And they have people who say, yeah, I can bank with Bank of America, or I can bank with Amazon, where I already get my groceries and my entertainment and everything else. Why not get that bank account from them as well? I get my phone, I get my watch, I get my laptop from Apple. Why not get a credit card from them as well? And I think that goes back to what Raj was saying before he left around what does this look like in terms of the regulatory environment? Because the danger here is when you have this theoretical, academic, no offense, conversation around what a bank is, and then you have the reality where everybody else is living in, where their bank is Amazon, their bank is Apple, their bank is any of these fintechs like ours, and these two conversations going on, and a whole chunk of how people are spending their money, living their lives, paying their bills, that is completely outside of the regulatory apparatus. That's a danger for those institutions, and it's a danger for the consumers, and it's a danger for our economy overall.
That's a great point.